Bob Iaccino is down at the CME to help us try and figure that out, talk some dollar as well. Joining us, of course, founder and chief strategist of Path Trading Partners. So, Bob, let's talk crude first. Some red despite green in stocks. Is this a function of dollar being higher, something crude specific? Is it not believe in the trade story or what?
Well, good afternoon, Oliver. I think it's a couple of things. I'm sure you guys discussed the potential for a conversation, at least, between the president and representatives from Iran, possibly brokered by France and Emmanuel Macron. I don't personally buy that, but that certainly was a good enough reason for anyone who was taking a long position into resistance to get out of that and not think that it would break through. I mean, we're short crude oil. We don't see a case
You're short
to be
crude?
long crude oil at all. Yes. And we don't see a case to be long crude oil at all. I don't see it. When you look at it from a perspective of what's going to spike crude higher, it's going to be geopolitics. But given the amount of crude coming out of the U.S., at least this point, it'll still spike crude. But we've seen the last couple of times there's been some sort of military problem, even a drone attack in Saudi Arabia didn't spike crude very much at all. And then you look at the seasonality trouble that you have with crude. 20 years of seasonality in terms of pricing in crude oil. And if you're looking at commodities and you're not looking at seasonality, you're missing a big part of it. It kind of tops off between about the beginning of August all the way to about the middle of September or so. That's kind of the peak, the apex of the seasonal move. So you're going to start to get those lower demand pressure just from seasonality, let alone from the slowing economy. So right now, the only thing I really see in terms of bullish possibility for crude oil is the potential for a geopolitical event or some sort of excess problem in U.S. production, which is going to be more slow to develop than we can see at this point.
How is that latter part shaping up right now, Bob? Because you and I have talked about this before, where while the sort of infrastructure difficulties of the shale have been limiting for a lot of the companies, eventually when those problems are solved, it seems like it should be pretty price negative in terms of supply being more available. But are we getting close to that, or are these companies still dealing with the same stuff they've been dealing with?
You know, it's a strange sort of perfect storm, Oliver, because we are getting close to that. We're coming up to some pipelines being available in the next 6 to 12 months. That's going to make that plus pipe we've always talked about of WTI cheaper, which will bring the price down overall. And then we have these falling rig counts. We had like 6-7 rig count weeks in a row of falling rig counts. 2 weeks ago, we went from I think it was 654 to 770, somewhere like that. And then we dropped back below that number again this week. So figure the last 8 weeks and rig counts have been slower, but the production is still there. So are we ending up in the situation where global demand is going to slow, the availability or at least the ease of getting WTI to port is going to bring that price down, and also pumping is going to slow a little bit all at the same time, keeping price basically where it is.
Yeah.
So even if we get that lowered U.S. supply with the ease of transport and the lower global demand, might not help prices.
Bob, we also discussed a while back about the differences between kind of the market that drives crude versus what drives stocks in terms of the way valuation and sentiment might have obviously played a big role in the multiple appreciation throughout the first 7 months of the year. Stocks were making new highs.
Right.
Oil was not. And I wonder if kind of we see that again today, where maybe a clearer-eyed look at the actual global demand and economic kind of outlook, as opposed to stocks where, maybe if Powell goes dovish, we can trade at 20 times earnings or whatever again. I mean, would stocks look more like the chart of crude if they were going purely on that kind of economic outlook or an earnings outlook?
Yeah, that is put better than I could put it, Oliver. That's exactly it. You could theoretically buy stocks for other reasons. It could be dividends. It could be potential multiple expansion based off the Fed. It can be that the Fed and the ECB are making a concerted effort to bump up the liquidity overall to do what they can from a monetary policy standpoint. It could be that the president is actually going to have some sort of fiscal policy in the form of tax cuts or shovel-ready projects to try and bump up the economy. Can't get that with crude oil. There's either demand or there isn't. And especially going into a seasonally weak period, there's no other argument other than geopolitics or perhaps a drastic production cut by OPEC Plus, which I don't see. Saudi Arabia is still eating most of that. So you're absolutely right. That is 100% the reason to not look at crude oil, at least in my opinion, from the long side now. And if you're actually interested in the energy space, this might be one of the times where I go into the stocks, and I've said I wouldn't do that, but this might be one of the places where you go into the XLE or you go into individual names that might benefit from some of the ethanol restrictions that are being removed, or perhaps the ease of pipe or the cheaper pipe to get the crude oil there that might actually benefit in a stock scenario rather than just a supply and demand equation.
Yeah, all right, I like it. There we go. Nice conversation, Bob. Energy, little change on the ETF, but crude oil down now about 80 basis points. So maybe not quite as bullish on that trade story. Bob, we got to run. Really nice work, Mr. Iaccino. As always, thanks for helping us figure it out.
Always good to be here.
Thank you. Bob's founder and chief strategist at Path Trading Partners.